Personal Finance, a comprehensive guide. Introduction. Personal finance is an essential skill that impacts every aspect of our lives. Understanding how to manage your money can lead to financial stability and independence. This course will guide you through various aspects of personal finance, from budgeting and saving to investing and retirement planning. Chapter 1. Introduction to Personal Finance. Definition and importance of personal finance. Personal finance refers to the management of an individual's financial activities, including earning, spending, saving, investing, and protecting resources. Effective personal finance management is crucial for achieving financial goals and ensuring long-term stability. According to a study by the Federal Reserve, 40% of Americans would struggle to cover an unexpected $400 expense, highlighting the importance of good personal finance practices. Effective personal finance management can lead to 1. Financial security, having an emergency fund to cover unexpected expenses, reducing stress and anxiety about money. 2. Debt reduction, avoiding high-interest debt and paying off existing debt more efficiently. 3. Wealth building, investing wisely to grow assets over time. 4. Retirement planning, ensuring a comfortable retirement through regular contributions to retirement accounts. Setting financial goals. Setting financial goals is the first step in personal finance. Goals should be specific, measurable, achievable, relevant, and time-bound. Smart. Examples. Example 1. Short-term goal. Save $1,000 for an emergency fund within 6 months. Example 2. Medium-term goal. Save $20,000 for a down payment on a house within 5 years. Example 3. Long-term goal. Accumulate $1 million in retirement savings by age 65. According to a study by the Dominican University of California, people who write down their goals are 42% more likely to achieve them. This underscores the importance of setting clear, written financial goals. Understanding financial planning. Financial involves evaluating your current financial situation, setting goals, and creating a strategy to achieve those goals. This includes budgeting, saving, investing, and risk management. 1. Budgeting. Creating a budget helps you track income and expenses, ensuring you live within your means and allocate funds toward your financial goals. The 50-30-20 rule is a popular budgeting method. A 50% for needs: housing, utilities, groceries. B 30% for wants: dining out, entertainment. C 20% for savings and debt repayment. 2. Saving. Establishing a savings plan is essential for building an emergency fund, preparing for future expenses, and achieving long-term goals. The average savings rate in the U.S. is around 7.5% of disposable income, according to the U.S. Bureau of Economic Analysis. Aim to save at least 20% of your income, if possible. 3. Investing. Investing allows your money to grow over time through the power of compound interest. For example, if you invest $1,000 at an annual return of 7%, it will grow to approximately $7,612 in 30 years. Understanding different investment options, such as stocks, bonds, mutual funds, and real estate, can help you make informed decisions that align with your risk tolerance and goals. 4. Debt management. Managing debt is crucial for financial health. According to Experian, the average American carries $92,727 in total debt. Strategies include prioritizing high-interest debt, consolidating loans, and making extra payments when possible. 5. Risk management. Protecting your financial resources through insurance and other measures is an important part of financial planning. For example, having health insurance can prevent medical bills from becoming a financial burden. Additionally, having a will and estate plan ensures your assets are distributed according to your wishes. 6. Retirement planning. Planning for retirement involves determining how much money you will need to maintain your lifestyle in retirement and creating a plan to achieve that amount. This includes contributing to retirement accounts like 401(k)s, IRAs, and other investment vehicles. According to the Employee Benefit Research Institute, only 58% of American workers feel confident in their ability to retire comfortably, highlighting the importance of early and consistent retirement planning. By integrating these components into your financial plan, you can create a comprehensive strategy that supports your short-term and long-term financial goals. Regularly reviewing and adjusting your plan is essential to stay on track and adapt to changes in your life and financial situation. Facts and examples. 1. Budgeting. A Gallup poll found that only 1/3 of Americans prepare a detailed household budget. Creating a budget can help you avoid overspending and identify areas where you can cut costs. 2. Saving. The Federal Reserve reports that 36% of Americans don't have enough savings to cover a $400 emergency expense. Building an emergency fund can provide a financial cushion in case of unexpected expenses. 3. Investing. According to Vanguard, the average annual return for the S&P 500 has been about 10% over the past 90 years. Investing in a diversified portfolio can help grow your wealth over time. 4. Debt management. The average interest rate on credit card debt is around 16%, according to the Federal Reserve. Prioritizing high-interest debt can save you money on interest payments. 5. Risk management. The National Association of Insurance Commissioners (NAIC) states that the average annual premium for homeowners insurance in the U.S. is $1,211. Having adequate insurance can protect your assets and provide peace of mind. 6. Retirement planning. According to the Social Security Administration, Social Security benefits replace about 40% of the average worker's pre-retirement income. Personal savings and investments are necessary to supplement Social Security and ensure a comfortable retirement. Chapter 2. Budgeting and Cash Flow Management. Creating a budget is a plan for your income and expenses. Start by listing all sources of income and then detail all monthly expenses, including fixed costs, rent, utilities, and variable costs, groceries, entertainment. Ensure your expenses do not exceed your income. Example, if your monthly income is $4,000, your budget might include $1,200 for rent, $400 for utilities, $600 for groceries, $300 for transportation, $200 for entertainment, and $1,300 for savings and debt repayment. Tracking income and expense. Regularly tracking your income and expenses helps you stay on budget. Use tools like spreadsheets, budgeting apps, or financial software to monitor your spending. Examples: Mint, a free budgeting app that tracks your spending, categorizes expenses, and offers budget recommendations. YNAB, You Need a Budget, a paid app that helps you allocate every dollar to a specific purpose and encourages proactive budgeting. Excel or Google Sheets, customizable spreadsheets for tracking income and expenses manually. Managing cash flow. Managing cash flow involves ensuring that your income is consistently higher than your expenses. This can be achieved by cutting unnecessary expenses, increasing income, or a combination of both. Example, if your monthly expenses are $3,500 and your income is $4,000, you have a positive cash flow of $500. To improve cash flow, you could reduce discretionary spending, for example, dining out less, or find additional income sources, for example, freelance work. Facts and examples. 1. Budgeting. According to the Bureau of Labor Statistics, the average American household spends $5,100 per month. Creating a budget can help you allocate your income more effectively and avoid overspending. 2. Tracking expenses. A study by the Consumer Financial Protection Bureau found that tracking expenses can reduce spending by up to 15%. Regularly reviewing your expenses helps identify and eliminate wasteful spending. 3. Managing cash flow. The National Endowment for Financial Education reports that 68% of Americans do not have a household budget. Proper cash flow management can prevent financial shortfalls and increase savings. Chapter 3. Saving Strategies. Importance of saving. Saving is crucial for financial security. It provides a cushion for emergencies, helps in achieving financial goals, and prepares you for future expenses. Example, If you save $200 per month in an account with a 1% interest rate, you will have approximately $2,421 after 1 year, including interest. Building an emergency fund. An emergency fund is money set aside for unexpected expenses, such as medical emergencies or car repairs. Aim to save 3 to 6 months' worth of living expenses. Example, if your monthly expenses are $3,000, aim to have an emergency fund of $9,000 to $18,000. This fund can help you cover unexpected costs without resorting to high-interest debt. Different savings vehicles. There are various savings options available. Option 1. Savings accounts, easy to access, but offer low interest rates. Example, if you deposit $1,000 in a savings account with a 0.05% interest rate, you will earn $0.5 in interest over a year. Option 2. Money market accounts. Higher interest rates than savings accounts but may require a higher minimum balance. Example, a money market account with a 0.1% interest rate would earn $1.0 on a $1,000 balance in a year. Option 3. Certificates of deposit CDs, fixed interest rates for a set term, but funds are less accessible. Example, a 1-year CD with a 1% interest rate would earn $10 on a $1,000 deposit. Facts and examples. 1. Emergency funds. A survey by Bankrate found that 28% of Americans have no building an emergency fund can provide financial stability and reduce reliance on credit cards. 2. Savings rates. According to the FDIC, the national average interest rate for savings accounts is 0.05%. Exploring higher yield options can increase your savings. 3. Money market accounts. Money market accounts often offer higher interest rates than traditional savings accounts. For example, some accounts offer rates up to 0.5%. Chapter 4. Understanding credit. What is credit and how it works? Credit is the ability to borrow money with the promise to repay it in the future. It is essential for making large purchases like a home or car and can also affect your ability to rent an apartment or even get a job. Example, if you have a credit card with a $1,000 limit and a 15% interest rate, carrying a balance of $500 will accrue $6.25 in interest each month. Credit scores and reports. Your credit score is a numerical representation of your creditworthiness, while your credit report is a detailed record of your credit history. Maintaining a good credit score is crucial for accessing favorable loan terms. Example, a credit score of 750 or higher is considered excellent and can help you qualify for lower interest rates on loans and credit cards. Managing and improving your credit score. To improve your credit score, pay bills on time, keep credit card balances low, avoid opening unnecessary accounts, and regularly check your credit report for errors. Example, if you have a credit card with a $1,000 limit, aim to keep your balance below $300 to maintain a low credit utilization ratio, which positively impacts your credit score. Facts and examples. 1. Credit importance. According to Experian, 67% of Americans have a credit score of 670 or higher. A good credit score can save you thousands of dollars in interest over the life of a loan. 2. Credit reports. The Fair Credit Reporting Act entitles you to one free credit report per year from each of the 3 major credit bureaus. Regularly reviewing your credit report helps identify and correct errors. 3. Improving credit scores. The Consumer Financial Protection Bureau found that 20% of consumers who reviewed their credit reports identified and corrected errors, leading to improved credit scores. Chapter 5. Debt management. Types of debt. Debt classified as good or bad. 1. Good debt. Borrowing to invest in assets that can grow in value, like student loans or mortgages. Example, a mortgage at a 4% interest rate allows you to purchase a home that may appreciate in value over time. 2. Bad debt. High-interest consumer debt, such as credit card debt. Example, a credit card with a 20% interest rate can quickly lead to large amounts of interest if balances are not paid off. Strategies for managing and reducing debt. Create a debt repayment plan. Prioritize high-interest debt. Consider debt consolidation and avoid accumulating the debt. Example: the debt snowball method involves paying off the smallest debts first to build momentum, while the debt avalanche method focuses on paying off the highest interest debts first to save on interest payments. Understanding interest rates and loan terms. Know the terms of your loans, including the interest rate, repayment period, and any fees. Understanding these can help you manage and pay off your debt more effectively. Example: if you have a $10,000 loan with a 5% interest rate and a 5-year term, your monthly payment will be approximately $188, and you will pay a total of $1,304 in interest over the life of the loan. Facts and example. Debt statistics. According to the Federal Reserve, the total U.S. consumer debt is over $14 trillion. Understanding and managing debt is crucial for financial health. 2. Debt repayment. The average credit card interest rate is around 16%. Prioritizing high-interest debt can save you significant amounts of money over time. 3. Debt consolidation. A survey by LendingTree found that 67% of consumers who consolidated their debt saw their credit scores improve. Debt consolidation can simplify payments and reduce interest rates. Chapter 6. Investing Basics. Introduction to investing. Investing involves putting your money into assets with the expectation of generating a return. It's a way to grow your wealth over time. Example: if you invest $1,000 in the stock market and earn an average annual return of 7%, your investment will grow to approximately $7,612 in 30 years. Types of investments. 1. Stocks. Shares in a company that offer potential for high returns but come with higher risk. Example: investing $1,000 in Apple stocks could potentially yield high returns, but the value may fluctuate significantly. 2. Bonds. Loans to a government or corporation that pay interest over time, generally lower risk than stocks. Example: purchasing a $1,000 government bond with a 2% interest rate will earn you $20 per year in interest. 3. Mutual funds and ETFs. Pooled investments that allow for diversification across many assets. Example: investing in an S&P 500 index fund spreads your investment across 500 large U.S. companies, reducing individual stock risk. Risk and return. All investments carry some level of risk. Higher potential returns usually come with higher risk. Diversifying your investments can help manage risk. Example: a diversified portfolio might include a mix of 60% stocks, 30% bonds, and 10% cash. This balance aims to achieve growth while managing risk. Facts and examples. 1. Investment growth. According to a study by Charles Schwab, the average annual return for the S&P 500 over the past 30 years is approximately 10%. Long-term investing can significantly grow your wealth. 2. Bonds. U.S. Treasury bonds are considered one of the safest investments. As of 2021, the 10-year Treasury bond yield is around 1.5%, offering lower returns but greater stability. 3. Mutual funds. The Investment Company Institute reports that mutual funds hold approximately $20.3 trillion in assets in the U.S. Diversification through mutual funds can reduce risk and improve returns. Chapter 7. Retirement planning. Importance of retirement planning. Planning for retirement ensures you have enough money to live comfortably after you stop working. The earlier you start, the better. Example: if you start saving $200 per month at age 25 and earn an average annual return of 7%, you will have approximately $528,000 by age 65. 1. Retirement accounts. 401k. Employer-sponsored retirement plan that offers tax advantages. Example: contributing $5,000 per year to a 401k with a 5% employer match and significantly boost your retirement savings. IRA. Individual retirement account. Personal retirement account with tax benefits. Example: contributing $6,000 per year to a traditional IRA can reduce your taxable income. Roth IRA. Contributions are made with after-tax dollars, but withdrawals are tax-free in retirement. Example, if you contribute $6,000 a year to a Roth IRA, and your investments grow to $500,000, you can withdraw the money tax-free in retirement. 2. Social Security and pension. Social Security provides a safety net, but it's important to have additional savings. Pensions are becoming less common, so personal retirement savings are crucial. Example, if your monthly Social Security benefit is $1,500 and your monthly expenses are $3,000, you will need additional savings or income to cover the difference. Facts and examples. 1. Retirement savings. According to the Transamerica Center for Retirement Studies, the median retirement savings for Americans in their 50s is $117,000. Starting early and saving consistently is key to building a substantial retirement fund. 2. 401k participation. The Bureau of Labor Statistics reports that 55% of private industry workers have access to employer-sponsored retirement plans. Maximizing employer contributions can enhance your retirement savings. 3. Social Security. The Social Security Administration estimates that Social Security benefits will replace about 40% of an average earner's pre-retirement income. Personal savings and investments are necessary to supplement Social Security. Chapter 8. Insurance Planning. Types of insurance. 1. Health insurance. Covers medical expenses. Example, a health insurance plan with a $500 deductible and 20% co-insurance can help manage healthcare costs. 2. Life insurance. Provides financial support to dependents in case of your death. Example, a $500,000 term life insurance policy can provide a safety net for your family in case of your untimely death. 3. Auto insurance. Covers vehicle-related expenses and liabilities. Example, an auto insurance policy with liability, collision, and comprehensive coverage can protect you from financial loss due to accidents or theft. 4. Home insurance. Protects against damage to your home and belongings. Example, a home insurance policy covering $300,000 for the structure and $100,000 for personal belongings can help rebuild and replace items after a disaster. 5. Disability insurance. Provides income if you're unable to work due to a disability. Example, a long-term disability insurance policy that replaces 60% of your income can help cover living expenses if you become disabled. Understanding insurance policies and coverage. Read and understand the terms of your insurance policies, including what is covered, exclusions, and limits. Example, a health insurance policy might cover 80% of in-network medical expenses, but only 50% of out-of-network expenses. Knowing these details can help you make informed healthcare decisions. Assessing insurance needs. Evaluate your needs based on your personal situation, dependents, and financial goals. Ensure you have adequate coverage without over-insuring. Example, if you have young children and a mortgage, a life insurance policy that covers 10 times your annual income may be necessary to provide for your family's future. Facts and examples. 1. Insurance statistics. The National Association of Insurance Commissioners (NAIC) reports that 91% of Americans have health insurance. Understanding your coverage helps manage medical expenses. 2. Life insurance. According to LIMRA, 54% of Americans have life insurance. Assessing your coverage needs ensures your family is protected. 3. Disability insurance. The Social Security Administration estimates that 1 in 4 20-year-olds will become disabled before reaching retirement age. Disability insurance provides a financial safety net. Chapter 9. Tax Planning. Basic tax concepts. Understand the different types of taxes you may owe, including income tax, property tax, and sales tax. Example, if you earn $50,000 per year, your federal income tax liability might be around $6,000, depending on your deductions and credits. Understanding tax brackets and deductions. Tax brackets determine your tax rate based on your income. Deductions reduce your taxable income, potentially lowering your tax bill. Example, if you are in the 22% tax bracket and claim a $10,000 deduction, you can save $2,200 on your tax bill. Tax planning strategies. Maximize deductions and credits, contribute to retirement accounts, and consider timing income and expenses to minimize taxes. Example, contributing $6,000 to traditional IRA can lower your taxable income. Bunching charitable donations in 1 year can maximize itemized deductions. Facts and examples. 1. Tax statistics. The Internal Revenue Service (IRS) reports that the average federal tax refund is around $2,800. Effective tax planning can increase your refund or reduce your tax liability. 2. Deductions and credits. The Tax Cuts and Jobs Act (TIA) doubled the standard deduction, making it more advantageous for many taxpayers. Understanding available deductions and credits helps reduce your tax bill. 3. Retirement contributions. The IRS allows contributions of up to $19,500 to a 401k and $6,000 to an IRA for 2021. These contributions can lower your taxable income and help you save for retirement. Chapter 10. Estate planning. Importance of estate planning. Estate planning ensures your assets are distributed according to your wishes after your death and can help minimize taxes and legal complications. Example, without a will, state laws determine how your assets are distributed, which may not align with your wishes. Wills, trusts, and power of attorney. 1. Will, a legal document that outlines how your assets will be distributed. Example, a will can specify who inherits your home, savings, and personal belongings. 2. Trust, a fiduciary arrangement that allows a third party to manage assets on behalf of beneficiaries. Example, a revocable living trust can help avoid probate and manage your assets during your lifetime and after your death. 3. Power of attorney, designates someone to make financial or medical decisions if you're unable to do so. Example, a durable power of attorney for healthcare can ensure your medical wishes are followed if you become incapacitated. Estate taxes and beneficiaries. Understand the tax implications of your estate and ensure your beneficiaries are up to date on all your accounts and policies. Example, if your estate exceeds the federal estate tax exemption $11.7 million for 2021, your heirs may owe estate taxes. Proper planning can minimize this liability. Facts and examples. 1. Estate planning statistics. According to caring.com, only 32% of Americans have a will or living trust. Estate planning is crucial to ensure your wishes are followed. 2. Beneficiary designations. A survey by Bankrate found that 63% of Americans have not reviewed their beneficiary designations in the past 5 years. Regularly updating beneficiaries ensures your assets go to the intended recipients. 3. Estate taxes. The Tax Policy Center reports that less than 0.1% of estates are subject to federal estate taxes. However, state estate taxes and other considerations make planning essential. Chapter 11. Financial decision making. Making informed financial decisions. Gather all necessary information, weigh the pros and cons, and consider the long-term impact of your decisions. Example, before purchasing a home, consider factors like your budget, mortgage terms, and potential appreciation. Analyze how the purchase fits into your long-term financial goals. Evaluating financial products and services. Research and compare financial products, such as bank accounts, credit cards, and loans, to find the best options for your needs. Example, comparing credit cards based on interest rates, fees, and rewards can help you choose the best card for your spending habits. Avoiding financial scams and fraud. Stay vigilant against scams by being cautious with personal information, verifying sources, and reporting suspicious activity. Example: if you receive an unsolicited email requesting personal information, verify the source before responding. Report phishing attempts to your email provider and the Federal Trade Commission (FTC). Facts and examples. Financial literacy. The National Financial Educators Council found that a lack of financial knowledge cost Americans an average of $1,279 per person in 2020. Making informed decisions can save money and improve financial health. Product comparison. The Consumer Financial Protection Bureau (CFPB) provides tools to compare financial products, helping you make better choices. Scams and fraud. The Federal Trade Commission (FTC) reported that consumers lost $3.3 billion to fraud in 2020. Being aware of common scams and taking precautions can protect your finances. Chapter 12. Course Review and Project Review of Key Concepts. Revisit the major topics covered in the course, ensuring a solid understanding of each area. Example: summarize key points from each week, such as budgeting methods, saving strategies, and investment basics. Use this review to identify areas where you need further clarification or practice. Final project. Create a comprehensive personal financial plan. Detailed financial plan that includes budgeting, saving, investing, debt management, retirement planning, and insurance. This project will help you apply what you've learned and set you on a path toward financial success. Example: outline your financial goals, create a budget, establish saving and investment strategies, and develop a plan for managing debt and preparing for retirement. Use tools and resources from the course to build a comprehensive plan. Facts and examples. 1. Financial planning. The Financial Planning Association found that individuals with a financial plan are 2.5 times more likely to save enough for retirement. Developing a comprehensive plan can enhance your financial security. 2. Review and practice. Regularly reviewing and updating your financial plan ensures it remains relevant to your changing circumstances and goals. 3. Applying knowledge. According to a study by the University of Chicago, individuals who applied financial education in their lives saw a 20% increase in their financial well-being. Implementing what you've learned can lead to significant improvements in your financial situation. Conclusion. Managing personal finances effectively is crucial for achieving financial stability and reaching your long-term goals. By understanding the principles of budgeting, saving, investing, and planning for the future, you can take control of your financial destiny. Example: implement the strategies and knowledge gained from this course to create a secure financial future. Continually educate yourself and adapt your financial plan to ensure ongoing success. Facts and examples. 1. Financial stability. A study by the National Endowment for Financial Education found that individuals with strong financial skills are more likely to experience financial stability and less likely to face financial crises. 2. Ongoing education. The Financial Industry Regulatory Authority (FINRA) emphasizes the importance of continuous financial education to adapt to changing financial landscapes. Staying informed and proactive in managing your finances ensures long-term success. This comprehensive guide aims to equip you with the knowledge and tools needed to manage your personal finances effectively. By following the lessons and applying the principles taught, you can achieve financial independence and security. This guide provides detailed facts, examples, and statistics to enhance the learning experience and offer practical insights into personal finance management. Hope you enjoyed the free personal finance course. For more such course, please post in the comment. Please subscribe to Stealthy Finance Tips channel for more course.